If you want to completely wipe out your tax bill, rental real estate investing is one of the absolute best ways to do this. In this video, I'm going to break down exactly how to use the real estate losses to offset W-2 and 1099 income. Let's dive in. If someone's trying to teach you how to use real estate losses to offset your W-2 or 1099 income and they don't teach you the passive activity loss rules, I would run for the hills. Let's go over what they are. Many people want to start real estate investing because they hear somewhere that it's a great way to reduce your taxes. And this is true, but getting the maximum possible tax benefits from real estate investing is not as easy as you might think. And this is due to something called the passive activity loss rules. The passive activity loss rules are rules that were established through the Tax Reform Act of 1986. And these rules limit the ability for taxpayers to use losses from passive activities to offset active income on their tax returns. These rules were put in place to prevent taxpayers from using losses from passive activities such as long-term rentals to offset active income from like a W-2 or 1099 job. So before 1986, yes, you could use losses from real estate investments to offset W-2 income. And after 1986, you can't, thanks to the passive activity loss rules. If you don't offset your W-2 income with rental losses, you can still offset passive income. However, the tax savings are much greater if you can offset active forms of income like W-2 or 1099. Luckily, there are a few legal ways around the passive activity loss rules in 1986. The first one is called the real estate professional status. Real estate professional status, aka REPS, is a status awarded by the IRS to individuals who maintain certain criteria in the real estate industry for tax purposes. Now, to qualify as a real estate professional under IRS rules, an individual must meet three primary conditions. 1, you must materially participate in a real property trader business. 2, you must spend 750 hours per year working in a real property trader business. And 3, you must spend more than half of your total working hours working in a real property trader business. So, for example, if you work 2,000 hours a year in total, you would need to spend more than 1,000 of those hours on real estate activities. What this means is to qualify for real estate professional status, you have to spend a very large amount of time working in the real estate industry. This makes this approach perfect for people who are already working in the real estate world or are unemployed. Some people who aren't already in the real estate industry switch over to spending more time in the industry to claim the status. However, it isn't easy for everyone to do this, but keep in mind, if you have a spouse, it is possible for your spouse to qualify for REPS on behalf of you both as a couple if you file joint tax returns. So that is another way to go about claiming real estate professional status. If you can successfully qualify a real estate professional on the tax return, you can use rental losses to offset W-2 and 1099 income. For example, let's say that your W-2 income is 150 grand per year, that you own your own real estate property and you qualify for REPS, and let's say that you have $100,000 in rental real estate losses from doing a cost segregation study. In this case, your taxable income drops from $150,000 to just $50,000. This would dramatically reduce your taxes. Starting to see the picture here? This is why offsetting active income is so important. But what about short-term rentals? I want to talk about short-term rentals here for a second because most people do not qualify for REPS. But just like REPS, the short-term rental rule is a tax provision that allows you to legally get around the passive activity loss rules as a real estate investor. However, unlike REPS, the short-term rental rule does not require 750 hours and spending more than half of your working time in a real property trader business. This makes the short-term rental strategy ideal for anyone who does not have that kind of time towards real estate activities or doesn't have a spouse who can qualify as a real estate professional in the real estate industry. Karlton, what is the short-term rental rule? I'm going to tell you now. The short-term rental rule is a rule that states that you can use rental losses to offset active income if the average stay at your rental property is 7 days or less. You also have to materially participate in the business, spend at least 100 hours working in the business, and work more than any other person in the business. So with the short-term rental strategy, it is possible to acquire a rental property, use it as an Airbnb or VRBO, and rent it out to people who are looking for short-term stays. If you can do this, the IRS will let you use losses from your short-term rental to offset your W-2 and 1099 income. The reason why this is the case is because it can be extremely difficult for the average person to become a real estate professional, but thanks to websites like Airbnb and VRBO, it is literally easier than ever to be a short-term rental property owner running an active rental business. But what are the differences? The reason why the IRS allows you to use short-term rental losses to offset active active income is because, generally speaking, short-term rentals require more effort than long-term rentals. Long-term rentals can be truly passive. You could set up a tenant in a long-term rental and forget about it sometimes. As long as you're the landlord and they're paying the mortgage every month, you're good. However, if you have a short-term rental, there will be more work involved. This is because you'll have to manage more tenants. You'll have to change the sheets, clean the property. You'll have to do more advertising as well. So because owning a short-term rental involves more active work, the IRS gives you a bigger tax break if you have a short-term rental. The key thing here is that you can use this to your advantage. And in fact, hundreds of my clients at Tax Alchemy have already done so. We use this strategy probably more than any other tax strategy firm in the nation. Some of my clients are even able to become completely tax-free by using this strategy. I want to talk to you about accelerating depreciation. Whether you go for reps or the short-term rental strategy to offset W-2 income, you're going to want to know about accelerating depreciation. Accelerating depreciation for rental properties refers to a method of claiming depreciation for the rental property in just a shorter time period. If you do this, you're going to get more front-loaded depreciation on the tax return. Property owners can claim more depreciation in the early years of ownership. This helps reduce the taxable income and provide powerful tax savings in the short term. If you aren't familiar with claiming depreciation, it's the process by which a property owner deducts the cost of the rental property structure over a period. In the United States, residential rental properties depreciate over 27.5 years, and for commercial properties, the depreciation timeline is 39 years. For most real estate, the straight line method is used, which means you deduct the same amount of depreciation each year for 27.5 years or 39 years, depending on which type of property you own. However, it is possible to use something called a cost segregation study to accelerate depreciation. A cost segregation study segregates the cost of a rental property into two categories: structural and non-structural. The IRS has shorter depreciation timelines for non-structural costs. This includes light fixtures, flooring, appliances, and much more. So by performing this cost segregation study, you actually write off a much higher percentage of your total depreciation in a shorter time period. In fact, many real estate investors are able to get 20 to 40% of their total depreciation amount within the first 5 years of a rental property ownership by using a cost segregation study. So by combining a short-term rental with a cost segregation study, you could potentially write off a massive amount of depreciation in the first 5 years of ownership of the property. In return, you're offsetting more of your W-2 or your 1099 income, giving you more cash in your pocket. Let's say that you buy a short-term rental by the beach in Maine and the building's worth $1 million. Remember, you can't write off the land because land doesn't depreciate according to the IRS. Now, let's say you perform a cost segregation study. After the cost segregation study is done, you find out that you can write off 22% of the building's value in year one. This would be a nice $220,000 worth of rental losses. Because of the short-term rental rule, you would be able to use these losses to offset your W-2 income. If you were making $175,000 in W-2 income, you would wipe out the entirety of your W-2 income. This is the power of the short-term rental strategy in accelerating depreciation. If you want additional information on this topic, check out this video right here. I go into detail. Now, if you're somebody that's sitting out there and you're like, Karlton, I make high income and I feel defeated every single year, this is why rental real estate could become that business for you. Many high net W-2 taxpayers understand that they need a business to offset their taxes. They're already maxing out their 401ks and giving money away to charity, and they probably already have a primary residence. So they're writing off property taxes and mortgage interest. They're going to their CPA, scratching their heads, wondering, what else can I do? Do I have to stop working? Do I have to give more money away? And the truth is, you need to invest your money right. You can save on taxes by investing your money into a cash flow producing property that simultaneously gives you depreciation to offset your active forms of income. We have hundreds of clients who have already done it. I'm going to approach thousands of clients pretty soon here who have already done it. Why are you not one of them? My name is Karlton Dennis. I'm here to help you save more money in taxes by doing things the right way, leveraging the government's rules the right way. And I want to get you closer to financial freedom by doing so. If you like this video, go ahead and like, comment, subscribe. You know what it is. I look forward to seeing you on the next one. Cheers.